family, how you guys doing today? It's yours truly, Robert, and I'm going to make another educational video for everybody. Today we're going to talk about Fibonacci and how it applies to us as price action traders. Now, the previous video that most of you guys saw was my support and resistance video. Now I just want to talk about Fibonacci, and that's because as an aspiring Forex trader, most people, the first things that they learn are Fibonacci, the tool, and then support and resistance. And as much as I would like you to not learn that when you're starting out, because if I could trade all over again and learn trading all over again, I would not even have started on MT4. There were things that I would have learned before even downloading the MT4 platform, okay? And unfortunately, I know that most of the people on here are aspiring Forex traders, and most of you guys have MT4 already installed. You're already dabbling around with it, and the unfortunate thing about it is a lot of people have kind of learned bad habits right from the start, and once you learn that, it's really hard to erase everything and start over again. You know, I had to do it, but I know a lot of people are not comfortable doing that. They're not comfortable just erasing everything they know and starting from scratch again. So the reason why I'm not starting, you know, and making these educational videos from the point at which I would really like to is because I know there are people right now that are trading, they're gambling their money away when they really don't know what's going on in the marketplace. And I just want to give you some useful tools that, you know, can hopefully help you out in one way, shape, or form by giving you a little bit more insight. Now, the videos that I would like to share first, they will be coming out, but just from what I see on Facebook and social media, I see people with the Fib Tool, you know, plotting support and resistance levels. I see questions on this stuff a lot, and I just want to go ahead and address it. So for the next, hopefully, 15 to 30 minutes, we're going to cover everything you need to know about Fibonacci, okay? And I want to cover it the way it was taught to me, okay? And you're not going to learn this from the textbooks, so this may very well be, for most of you guys, the first time you're ever hearing this described this way, okay? And before we get started, I just want to go ahead and ask people that are watching this, I want you guys to perform this exercise with yourself. I want you to ask yourself, why does price retrace? Why? And, you know, I find a lot of people, they have no idea why price retraces at all. They don't understand that after a swing low and a swing high is formed, why does price retrace that range? Why does it do that? What is happening? What's going on that's causing price to do that? Because that is where you need to start. If you're going to use a tool that measures retracements, don't you think you ought to know why price is retracing in the first place? So you can maximize your earning potential using the tool. So that's what I want to go ahead and cover with you guys, okay? And I found that the textbooks, they don't teach you why price retraces. They teach you the standard levels on the Fibonacci tool, which when you look at my Fib tool, mine is completely different. See my Fib tool? This is 100% different than what you find on any textbook educational course. I don't have the 32% on here or the 23 level. I don't even know the exact levels, to be honest. I just round up. You know, I have 62.79 here. I think the actual one is 61.8, so 61.8. I just rounded to 62. I think this is 786, so 78.6. So, you know, the textbook stuff for me has never worked. And you can see that my Fib tool doesn't look like what you find in the textbooks that have the 23 level on here, the 38 level, whatever those are. I don't even know. I deleted them so long ago that I don't even know, because they're useless to me. They're absolutely useless. And I see all the time people are preaching on Facebook, oh, you know, the 38% is my favorite level to trade off of, the 23%. No, it's not. Not after you watch this video. After you watch this video, that will be you know, argued against very, very well. And I don't think you're ever going to use those levels again. Okay? Now, you know, you guys can argue me however you want, argue with me about, oh, you should have the 38 on here, the 23. Well, you guys are watching my video, okay? You're here, choosing to learn and get insight from me, not the other way around. I know this stuff works. I use it every day, and I'm not changing my methods. I'm not changing what was taught to me and what I've seen work time and time again, work more consistently, more clearly, and make more sense than what I learned in the textbook stuff. So, I don't want to hear comments from people saying, oh, the 38 does work, the 23 does work. Great, use it then. That's you, but you're on my video watching my education. So this is what I'm going to teach, and if you don't like it, then you can go back to your own methods. I'm just teaching you the way everything was taught to me by one of my mentors, which by this time, if you've been watching my videos, you guys know who I get some of these different concepts from, okay? I'm very clear about who my mentors are and who I gained this information from and how it was presented to me. So we're going to go ahead and look at a range here. This is a daily chart of the Euro USD, and what we're going to look at is this up move right here, okay? This move that started in December of 2015 to about let's see here, April-ish into May area. We're going to look at this move that took place right here. Okay, we're just going to look at a few of the retracements, and we're going to talk about why does price retrace. Okay, so the way we use the Fibonacci tool, okay, is it's a tool that measures a retracement from a swing low to a swing high, okay, or a swing high down to a swing low. It measures a potential retracement into that range, okay? As you can see right here, we have a swing high and a swing low, okay? This creates a trading range, and price traded back up into that range before trading away from it, okay? That's a retracement right here. We see the same thing occur right here. We have a swing low followed by a swing high, and we get a retracement of that range before price eventually trades away from it altogether and forms what we call an equal leg higher. This is something that we refer to as range expansion. You have an initial range from the low of this candle to this high. After the retracement, you should get an equal range in length. Okay, so I'm just going to grab this range right here, stick it at the bottom of the candle here, roughly, and we see a pretty much equal range formed afterwards, okay? So that's range expansion there, okay, equal range. So the next thing you can look at here is you have a swing low here, followed by a swing high, and a retracement of that range, okay? We take the low to the high, that's our range. Here's a retracement of that range. After the retracement, we have an equal leg right here that forms, okay, afterwards. Okay, so why does price retrace like you see on the chart? Even here, we see a swing high here, a swing low form, a swing high, retracement of it, boom. It trades down, followed by a bullish move up that takes out that swing high. And then we round the top here, okay, we form another swing high, swing low, we retrace back down into this range right here, okay? So here's a range, low to high, there's a retracement, okay, with an equal leg higher. See that? Pretty much equal leg higher form, range expansion. So why do we see that, okay? Why does price retrace, and how do we use the Fib tool? Well, the Fibonacci tool is up here, okay? And the way you use the Fib tool is you're going to anchor it from the swing low to the swing high that you want to measure the retracement of. Okay, that's what you do. You anchor it from the bottom low right here to the top, to the high. You're going to form the anchor. Okay, now you can slide it left and right to draw the lines out and extend them like a ray so you can see them a little more clearly, because that's a little, kind of hard to see. So I like to extend it out just a little bit so it's a little more clear. Okay, now my levels here. I want to talk about my levels right here. Okay, I only have a 50% equilibrium level, okay, a 62, what I call the sweet spot, okay, what my mentor, he calls this a sweet spot, which is simply the middle of the 62 and the 79. Okay, it's 70.5. That's the level right there. To edit the levels on your Fib tool, you just right-click and go to Fib Properties. And you can just edit them right here. You just add the level that you want, and you can name it whatever the hell you want to do. You can name it 62% bang on trade, golden money, green light, go, blast off. I don't care. A lot of people, copy exactly what I have here. You're like, well, what do you name? What's OTE mean? Well, that's, an ICT phrase, optimum trade entry, but you can name it whatever you want. It doesn't have to be exactly like this. I mean, I'm a simplistic guy. I just take what I was presented to me and put it on here. But I know some people that they rename them. I just have sweet spot right here because that's a good spot for me. But you could change it to, like I said, whatever you want. Like green light, bang on, blast off, go. I don't care. It doesn't matter. So, anyways, those are my levels. Okay. Now I like to display the price level over here as well. I'm not sure. To be honest, I don't even know if the default Fib tool does that, shows a price level. But the way you get that is in the description, you put %$. That will display the price of each level that you have, okay, where it's currently at. Okay, so that's how you do that. Now, my Fib, I like to have mine black, just personal preference. As you can see, I have people ask me too, what is my background? Like, how do I get this template? Like, it's some magical template. I'm going to show you guys the magical template that I have. Ready? You guys won't believe me. I'm going to show you how magical this is and how you can get it. Ready? Because I get this question all the time. How do I get your template? Where do I acquire this magical tool? You right-click. You go to Properties, and you go to right here to Color Scheme, and you go to Black on White. Yeah, it's default. You bet you didn't think that, right? Like I said, you don't have to have these crazy colors. I use a default template. Why? Because I don't need a gazillion colors on my screen. It does nothing for me. I like black and white. It gets the point across pretty well for me. I'm a very simple price action trader. No indicators, no nothing. Just what you see on the screen. Because the concepts that I know, completely makes crystal clear all of what you see on the screen. And that's all you're going to need to know to learn how to trade. But anyways, back on track here with the Fib tool. So you're going to anchor it from the swing low to the swing high. And you can see that we have a retracement. Now, we retrace down to the 62% retracement level. Just through it just a little bit. Okay, and then we see a rally away from it. Okay, now this is the way I see the Fib tool. This area, okay, let me drag this down for just a second so I can get my rectangle. This area right here between the 62 and 79, that is where I am targeting the continuation of the range and range expansion to occur. Okay? That's where I would like to see price get to. 62, my sweet spot, which is 70.5, or the 79 retracement. This is, in my opinion, where I'm aiming for. Okay? Now, why do I aim for that area? Why do I like those three areas? Well, now we're going to talk about why does price retrace itself? Why? Because if you know why, then you will know why you should never ever be using the 23% or the 38% retracement level. Okay? I want you guys to look at the range here. Study this range. You have a low to a high. Look at this daily candle right here. This is 1 day's trading. We have a massive rejection and a massive range form. Okay? Inside of this range, there was not a lot of trading going on. Okay? There was not a lot of trading going on. This low right here, okay, comes down near this low over here. Okay, it could very well be considered what we call a stop run. Now, for whatever reason, the market makers, the funds, the institutional traders, the smart money traders, they had a lot of orders paired right here. Okay, probably on limit. Okay, they had massive amounts of long positions down here resting. When they were triggered, we had a massive buy day. Massive. Now, it could have been news. It could have been, I don't know exactly what day this was, but regardless, there was a massive injection of volatility and liquidity into the market to cause this one massive candle to form. That means that in the middle of this candle, there wasn't a lot of orders paired. There wasn't a lot of trading going on. All that was down here. Because think about it. Where did all those orders be executed, right? The institutionals. If they had a lot of funds placed down here and they wanted to inject a lot of liquidity into the market, they only do it once. Those orders are only triggered once. The injection of volatility is only injected once. And if there's enough of it, it's going to cause a massive rally in price. And there's no other orders being paired as it shoots up like this. Well, for whatever reason, at this point in time, they decided we're going to turn into buyers. And this is where you see a trend shift here, upward. Okay? Now, this is when they decided we want to buy. We want to become net long. And they inject a lot of liquidity into the market. We see a massive liquidity void right here. That's what we call this candle. This is a liquidity void, which means that there's not a lot of trading going on here. Okay, so what happens? When price gets up here to this swing high over here, the smart money, they don't want to take any more long positions because price right here is no longer at a discount. This is a retail price level. Down here, if they bought down here, this is a wholesale price level. Look at the difference. What's the difference? 4,800 pips. Okay, that's the difference. 4,800 pips is a difference. Okay, so down here was wholesale pricing. Up here, retail pricing. Neophyte traders, okay, the retail traders, where do they buy? Were they buying down here? Probably not. They were buying somewhere around here, probably somewhere up here too, thinking it's going to keep going higher because retail traders buy retail prices. They don't buy wholesale prices. Okay, what the market makers did was as price shot up here, they were done buying. They were done adding positions to their longs down here. Why? Because this is no longer a good opportunity for them to get long. What they're going to do is sit on the sidelines and they're going to stop adding long positions. When the market makers stop adding long positions, you see price trade down because it has no other option. Everything you see on the screen right here is the banks. This is it. If the banks aren't buying, price is going down. That's how it works, right? So they were done buying up here. So price trades down. Why are they letting price trade down? Well, so they can capitalize on a more discounted price to add more long positions to their previous positions over here. Okay? Now, this range right here, low to high, excuse me, okay? 50%. This level right here, the reason why we call it equilibrium, okay, you can also call the 50% level the fair market value, okay? And I'm going to write that. Okay, this level is what we deem, and the market makers deem, is fair market value, okay? What that means is that this level right here is where they deem this price swing right here. 50% of this price swing, this range, is deemed as fair market value, okay? Think about it, okay? If you're buying a house, do you want to buy a house above market value or at market value? No. You want to buy a house below market value at the most discounted price you can get. The same concept occurs here. Right here, at this swing high, you have a range form, a low to a high. The 50% level of this range is what the market makers deem to be fair market value. They don't want to buy any more positions above the 50% fair market value of this previous range. So what do? They allow price to trade down to a discount. Anything below 50%, okay, we're going to go back to my chart here. We're going to insert shape, rectangle, 62 to 79%. Anything inside of here is what we consider to be discounted pricing. Okay? And this is where they want to do their buying, inside of here. Okay? That's why I never use a 38 or 23% retracement levels, because those levels are above 50%. They're over here somewhere. Okay? That's above fair market value. Why would you be buying above market value when you can be patient and wait for a price to get to a discounted pricing level, a wholesale pricing level, and then you can take a trade down there, like the banks do. And then you see this organized move. You see range expansion to the upside. Here's your initial range. There's your retracement. Boom, you get range expansion, almost an equal leg formed higher. Okay? So, that's why price retraces. That's why I use 62, 70.5, and 79% retracement levels. Okay? Now, I'm going to just go ahead and answer the question. Why do I round? Well, if you watch my support and resistance video, we know that banks love round numbers. I love round numbers because of that. I like to trade like the banks do. If the banks like round numbers, I like round numbers. Everything I like round. Even these, I like round. So that's your answer. Plain and simple. Okay? So, just to show you guys some more examples of Fib Tool, we have a swing low here to a swing high. Low, high. We're going to anchor the low to the new high that was formed. And where do we hit? 79%. And then we trade up. Okay? What do we have? We have a swing low, swing high. Low to high. This is a larger swing. We trade down to it. A little bit through it, but it gets down there nonetheless. Ends up trading away a little bit. Okay, you can look at shorter term swings as well. Okay? Let's look at this swing right here. Low, high. What do we have formed? We have a low to a high. Boom, right down to your 79% retracement level. Trades away. Okay, let's look at another example here. Let's see here. Let's look at the reverse side, okay? Right here, this high right here that took out any resting liquidity up here was the beginning of this down move that broke market structure here. So now we're going to do the opposite. We're going to measure retracements of a bearish market. So you have a swing high to a swing low. Boom, we retrace right up to it, 62%. Okay? And it actually continues farther up on this leg over here. Okay, so we see a good example of a retracement there. Let's see here. We get a little low formed here and a swing high. Okay, and look at same example. Massive liquidity day. Massive liquidity day. Liquidity void. Not a lot of trading. They want to come back down into this range to recapitalize any long positions that they can get themselves into. Low to high. Boom, right down into 62%. Right there. Okay, low, high, same example. Right down in that 79. Okay, let's see here. We have swing high form here. Swing low that broke market structure twice, took out that low and that low. Now we may be bearish coming in, in the long term here. So swing high, swing low. We trade right up to 62%. We trade away from that level. Okay. Shorter term swings we can look at right here, swing low, swing high. Let's take a peek at this. So up to the high, we trade right down to that sweet spot level. Hits it to the pit pretty much. Okay. You get the same thing here, low, high. We'll measure this move up to the high. Again, we trade right down into the sweet spot, just almost pegging the 79%, trades away. Okay. Now, we're also going to talk real quick about Fibonacci extension levels. Okay. Now, the Fibonacci extension levels are a way for you to forecast where price is going to go after a retracement. Okay. So I'm going to zoom out here. Now, the way that I have my Fibonacci extension tool set is I have extension levels on my actual regular Fibonacci tool. See my extension levels here? The other way to do it is if you go to Fib, you actually have, let me delete that. You actually have to go to insert Fibonacci expansion. You can use the expansion tool, which I never use. I just add the levels to my regular Fib retracement level, because all they are levels to the upside, though, past 100%. Okay, so my Fib extension levels that I have, okay, is the 127 extension level and the 162. And actually, I want the 200 on there as well. Okay, I don't know how that must have got off, but these are profit-taking levels. Okay, they're objectives to the up or downside after the retracement that you can expect price to most likely get to. Okay, so the way we use it is we're going to look at this area right here. Okay, we're going to measure the retracement. Okay, so we anchor from the low to the high. Okay, now we see it retraces down to the 62% retracement level. If you get into a long position here, your next objective is to figure out, when should I take profits? Where are my higher upside objective levels? And you can use the Fib extension for that. The way you do that is you measure the retracement, which is from here down to here. Okay, and look at what you get. You have first take profit level, 127. We get there handsomely, easily, and then we reach even up into the 162. Okay, and for some reason, my 200% level does not seem to be on here, because I don't know why it's not on here. Why are you not on here? Maybe it needs to be 2. There we go. Okay, 200% extension level up here. Okay, and we end up reaching up there eventually in time. After a larger, deeper retracement level, we end up getting up there. Okay, the other way you can do it too is measure the range, the initial range. Okay, this impulse move from low to high. Okay, measure that. Okay, kind of line it up. And you can see we end up hitting the 200 in time. Okay, 200% retracement or extension level. Okay, the way that I use the extension though is I just extend from the retracement itself. Okay, so we have a high to a low. When I buy the retracement down here off the 62 level, my first take profit objective is going to come at 127. I'll take a little bit of the trade off, then the 162. And then eventually, longer term, hopefully we reach up into the 200 level. Okay, and you can do that on all these extensions. So we have a low, high, here's a retracement. We'll draw the expansion level. We end up getting the 127. Not quite the 162, but the 127. Okay, and if you want to do the range itself, the initial impulse move, you can go high down to the low. And we, again, kind of same concept here. It gets up to the 127 extension level. So that's how Fibonacci extension works. It can be used to plot upside objective levels, first take profit levels, and things like that. And like I said, the ones that I use are the 127 extension level, the 162 extension level, and the 200 extension level. Those are the ones that I use, the ones that I find that are most commonly taken out first. And that's it. Let's see what the default one even has. Fibonacci expansion. Let's go ahead and make it black so I can see what the heck is going on. Okay. So you have 618, 100, and 1618. So that's 162 essentially. Okay. Mine is a little bit different. I got 162 because I round on my numbers. So, you'd have to essentially add the 127 to it, the 200 level, however you want to make it. So that's a little bit about Fibonacci. I think that's going to pretty much wrap up the video here. We covered a good amount of information on how to apply Fibonacci and how it relates to us as price action traders and aspiring Forex traders. And you learned why price retraces. very important concept to understand. And you learned a little bit about how I utilize Fibonacci, and hopefully I kind of disproved the belief that we should be waiting and trading off of 38 levels into 23 level and things like that, because the banks don't do that, right? I only trade the methods that the banks do, okay? And the banks don't trade there because it's above market value for them. They don't want to be buying and trading off levels that are above market value. They want discounted prices. They want wholesale prices. They're always the first ones to execute a move, okay? Because they're always buying wholesale price levels. They're not, retail traders. They don't buy retail levels, okay? Important to understand that concept. So with all that being said, I hope this was of some significance to your trading and it helped you out. And if you have any questions, comments, or concerns, like always, please feel free to PM me, comment below, email me, whatever you have to do. These concepts of Fibonacci were, again, shared to me by one of my mentors, Inner Circle Traders, Michael Huddleston. He was the one that really cleared up my perspective on Fibonacci. And, you guys can take this information as you wish, apply it or not. But I always challenge you, the same way that it was described to me, is take the concept and practice using it and see it for yourself. Once you see it in the charts for yourself, that's when you'll start to believe it, okay? Don't just believe what I'm telling you. I want you to go in front of your chart and look at it, and I want you to see it, okay? Don't just blindly follow me. See it in action, okay? And I can show you numerous times of price hitting those levels on the dot to the pip, okay? Precision, okay? But it's not what I can do for you. It's about what you guys can do with this information and how you're going to apply it and how you're going to learn how to trust it, okay? And that's going to come from you spending time in front of the charts and seeing it for yourself, okay? These concepts are not something that you can just grab and go, okay? You have to, look at them over and over and over again. That way you can, anticipate when, retracements are going to occur, how deep they're going to go, things like that, okay? And there are going to be more educational videos I'm going to put out there that will kind of, bring all the concepts and bring them together on how you can utilize all of them. But, by far and large, with simple Fibonacci application and support and resistance levels, you have a really good basis of framing trades off of, okay? Even right here, you have a swing high, swing low. What are we going to do? We know what we're going to do. I'll even do this. Swing high, swing low. We're going to draw the range, okay? We have a 62% retracement level, and let's look at any resistance, okay? We're going to pretend as if we did not see this move yet, okay? We're going to pretend that price is right about here, okay? That's what we're going to pretend. Okay, and let me actually get over to that area so I can better show it to you, okay? We're going to pretend that we see price right about here, okay? This candle up, okay? Because it's easy to look at hindsight, okay? But it's hard to forecast the right, okay? The way that I would look at this is I'd see all these clean highs here, okay? This high right here. I'm going to look at what levels around this area, okay? Well, you can see how we have the 114.50 level. And back to support and resistance. What is the significance of this level? It's a mid-figure level, okay? 114.50. Mid-figure level, okay? Now, I can see that we just bottomed out here. We had a swing low form, okay? So high to low, what are we going to do? We're going to take our tool, we're going to draw the level, okay? Where does my sweet spot lie? In the 62. Right around this mid-figure level. So I would be anticipating, okay, a green light sell around this area based on the simple fact that, oh, good grief, how do I grab this freaking arrow? Okay, based on the fact that there's an area confluence here, excuse me. Okay, we have a mid-figure level, support and resistance, followed by my discounted pricing level on the Fib, past the fair value. And what do we see happen? Price ends up trading up toward and just through the 62, very close to that level. How many pips off are we? We are about, give or take, 20 pips. So, but this is on a daily chart, so you have to take into account obviously spread and things like that. But you know, adding an 8 pip buffer or whatever, it got pretty close to it. Okay, and you could have even form fitted this line even better. You could have probably even used the 20 level, 1420 level. And why do we use that level? Because that's also an institutional level. So if you had, and you were, you know, aware that the fact that there's also a 1420 level that also price reversed off of here pretty decently, then we trade right up to it. And the 1420 level lines up perfectly on top of the 62% optimum trade entry Fibonacci level. So again, same concept. You would be stoking out short positions here. Okay, support and resistance completely overlies the 62 confluence area. And what do? We trade right up to it. What was a high on this candle? The high on this candle comes in at 114.28. This candle, the high came up to 114.21. It went 1 pip above the level. If you got in, if you had a sell limit, okay, an order on limit here to sell the market, okay, you would have sold it here, price would have traded down, you would have went into immediate profit. Immediate profit, that's the high. When it hit your sell limit order, it would have traded right down to a 37 pip profit immediately. If you held the position, it would have came up against you and went 20 pips against you before aggressively rallying down quite a bit. Quite a bit. Let's just say that, quite a bit. Okay, couple hundred pips here. Okay, 200 pips or so. Okay, so with that being said, okay, you can start to grasp the idea here of blending concepts together, okay, in blending understanding of the marketplace and how things can start to come together to give you an idea on how to frame trades, okay? Now again, this information alone is not enough to frame a trade off of. You need to have other concepts in mind, okay? These are great concepts and they look all fine and dandy on the left side of the chart, but it's the right side of the chart that you're going to find problems with, anticipating a reversal off a key fib level, okay? That's always a challenge, is over here, and you're going to need to know other concepts to forecast the right side of the chart. But this information alone is going to offer a start to your track on becoming a successful Forex trader that's profitable. So now I'm going to wrap up the video before I start going on another tangent. I just wanted to show you guys that. So with all that being said, I hope you guys enjoyed, and good trading. Take care.